Okay, so in the grand scheme of things, we work through our market system here. We've got the supply and demand from households. We get the government involved. We get the rest of the world involved with international trade. So I kind of slowly bring you through layering more and more complexity on to what the big marketplace looks like. And we eventually got to our plate of spaghetti in chapter 6 with the financial markets and how those are global in nature, that anybody can buy U.S. government bonds if the United States government hasn't collected enough tax revenue to pay for their spending, then they issue those IOUs. We learned that Janet Yellen can buy those IOUs. That was one important player in the market. Let me get out. I might have a need for a few of these props here today, too. So we had Janet Yellen who bought these, and we have China that might want to purchase these too. And in fact, about half of the amount of these notes outstanding are owned by foreigners. So we kind of reached a tipping point that we'll talk a little bit more later, a tipping point in the sense that foreigners held more of the U.S. government debt than did U.S. citizens. That had never happened in history before. And from a macro perspective, it kind of makes you think a bit, so if that's okay or not. So think of it this way. If President Obama wants to go into debt and issue a bunch of these, and it ends up being Sarah and Samantha that buy them, right? So now the debt is owed from future generations, but it's kind of cycling back to Sarah, cycling back to Samantha. It's cycling back to U.S. citizens. So from our economy perspective, it's kind of all staying home, if you will, right? We have different agents that might be taking on that debt, but it's all staying within our boundaries. And so there had always been foreigners that started to buy little bits of government debt, and then here in I don't know when it tipped, the late 2000s, foreigners held more of these than U.S. citizens. And so that was like, is this okay that we owe, the rest of the world some of our sovereign debt or not? I always argued that I think that's a great position to be in. I think that's awesome. Because if we reached a point where we were thinking, maybe we don't need to pay these guys back. Right? Now we're not paying back our citizens, we're just not paying back China. Now that might lead to World War III, that would be kind of the negative part. But we could kind of flip them the bird and say, hey, I'm not paying you back, suckers. Right? And so who's in the better position? Is it the United States or China that's holding all of our debt? I'd kind of argue we might be in a decent position in that respect. But, that gets into a lot of different issues, not the least of which maybe World War III would be significant. So, the next picture on your figures is figure 2.9, and it speaks to the currency market that needs to be in place in order to facilitate international trade. So we have exports and imports flowing back and forth from countries. We have financial assets, such as what I just mentioned, U.S. government bonds and other sorts of financial securities that are being exchanged around the globe. And ultimately, if you live in Germany, you need that currency, you need some euros to go run to Walmart and buy stuff with. If you're in the United States, you might have dealt in some foreign bonds, but you need U.S. dollars to go run to Walmart with. So we kind of have a need as an investor to get the money back into the currency in which I normally trade. And so that sets up this currency market. And so in here, we've got players in the currency market of consumers as well as businesses, and governments are in here too. And the visual that I have for you is just to think that when we buy stuff from the rest of the world, they don't take dollars. Dollars are not money in China. They need yuan. And so there's a separate transaction that's going on. I might have bought and sold some plastic toys from China, but I need to convert my dollars into yuan in the foreign exchange market. And that's a separate transaction going on that's outside of the actual purchase of the purchase and sale of the goods and services. And so that's what we're going to explore in Chapter 9, is that foreign exchange market. And it's a little bit different of an animal because we're dealing with the currencies rather than the actual good itself. All right, so I'm going to start off this chapter with a little supply and demand, because I find that it's easier to just kind of lay that out for you right from the get-go rather than to maybe talk about some of the other dynamics first. So, the foreign exchange market. This is Chapter 9. The foreign exchange market. We've got our normal looking supply and demand curve here. In fact, let's just go ahead and draw a demand curve and an upward sloping supply curve for reasons we'll get into here in a bit. And we are measuring the quantity of money, but the quantity of dollars. Now this looks awfully familiar for the test coming up on the money market, right? The money market measured also the quantity of dollars. Well, this is kind of different. We're identifying the quantity of dollars that are being used for foreign exchange, for foreign trade in the currency market. So I kind of want to put a couple extra notes here. And this is the dollars being exchanged for other currencies. And that means it's quite a bit smaller than the money supply we talked about in Chapter 8 with the money market. The quantity of money, M1. M1 is, what is it? Currency out in circulation outside of the bank vaults, plus checking account deposits. If we add M2, then we'd be bringing in savings, money market accounts, certificates of depression, all of that stuff. We've got the entire money supply is big. The amount of money that's being devoted to the foreign exchange market is a smaller subset of that, right? How many dollars were devoted to foreign exchange? Consumption in the United States was 70% of that $15 trillion. Our C plus I plus G plus X, right? If we do our cigarettes, C plus I plus G plus X, 70% was kind of domestic purchases. And foreign trade made up a smaller fraction of that, with exports and imports around 15%. And then with our trade deficit needing to make up the difference there. But it's a lot smaller fraction is all I want to call to your attention, because that can be a little bit confusing. Okay, and then over here, we start thinking, well, what's the price of a dollar on the foreign exchange market? What are you really buying with a dollar? And so if we think about the Japanese yen, for instance, what are we buying? What's the price of a dollar? It's the conversion rate. It's the exchange rate, right? So over here, we're going to measure E. E is the exchange rate, and it is yen per dollar. So for instance, where the two lines cross, maybe this is an initial trade amount of an exchange rate of 100. So what does that mean? It means currently 100 yen equals $1, right? So that is the trade. That's what the value of the dollar. What's the dollar worth? What's a dollar worth to you? Well, it's worth 100 yen in this particular market, right? So it kind of reflects how much you're giving up in terms of yen to hold that dollar. You could be getting 100 yen. Okay, so, and this is the quantity of dollars exchanged here. So let me just put a Q1 and an E1. Now next what I want to do is pull a shifter out, and I know I'm doing this completely in a different order than what we normally do, so bear with me, I'll try to make sense of it all. But I want you to put a D2 over here, and when you draw it, I want you to draw it such that you actually shift both curves such that the new equilibrium is directly above the old one. So it's kind of reverse engineering. We're going to try to explain what's going on. And then let's say that we've got the new exchange rate is at E2, and now it's 120 yen. So if that's happened, has the value of the dollar gone up and down? In other words, if we start thinking now in terms of what we're going to do in this chapter, appreciation or depreciation, is your dollar more valuable? Has it appreciated, or is it less valuable? It's depreciated at, let's just call this point A versus point B here maybe. It's appreciated? It's all on a per dollar basis, so you just kind of want to think to yourself what this means here of 120, and that's why we got this notation here. It's 120 yen per dollar, and it used to be 100 yen per dollar. Do you think your dollar, does that sound like it's more valuable or less valuable? You're getting more for your dollar, right? So you're getting 120 yen, whereas you used to only get 100. So it's like the value of your dollar's gone up, and that's indeed what it is. There's an appreciation of your money because one single dollar is now getting you 120 yen as opposed to 100. So this is showing appreciation of the dollar. China having inflation or America having deflation? Let me hold off on that. We're going to come to the causes of that later. And ultimately, that's the underlying thing here is why these curves shifted. And we'll get there. We'll explore various reasons why that might happen. Okay, so right now, I just want to hone in on what appreciation is versus depreciation. So at point A, the exchange rate equaled 100 yen per dollar. Now look at the way I'm doing this notation. You might remember back to a previous lecture where we talked about the price of Mountain Dew and the price of Starbucks or something. I still owe you the $2.75 for the Red Bull, by the way. So don't let me forget that. So we talked about the relative prices, and we kind of used this weird notation with cars and food. So we're going to kind of see how that plays out here in this chapter too. And at point B, the exchange rate equals 120 yen per dollar. Since E2 is greater than E1, there's a bigger number. The dollar has appreciated. What does that mean? You get more yen per dollar. Now, what happened to the yen? Did it appreciate or depreciate? It depreciated. So that brings us to another important point here, is that if one currency is appreciating, the other one has to be depreciating by default, right? So you can put your Japanese hat on here now and say, oh, wow, well, it only took me 100 yen to buy a dollar. Now it's taking me 120. That sucks, right? So the yen has depreciated when this goes on. So let's just put that extra note here. The yen has depreciated. So one currency going up means the other one must have went down. Okay. Questions or comments on that? So, why? Let's start off with some demand shifters. So number one is a change in the rest of the world's demand for U.S. exports. A change in the rest of the world's demand for U.S. exports. So, if we are an exporter of chopsticks, which by the way we are, kind of an interesting story that we provide the Chinese their utensils. We are a net exporter of chopsticks, a little known fact that you might want to remember next time you go to a Chinese restaurant. So if there is an increase in the demand for chopsticks, what happens to the demand for dollars in the foreign exchange market? Would it tend to go up or down? Did I not bring my golf club? Oh, mercy. How could I get into this one without the golf club? All right, so I'm going to have to do the modified arm here again. So would the demand curve shift to the right or to the left if there's an increase in the demand for U.S. exports? To the right, right? So again, the dollars kind of follow the goods. If you want to buy more chopsticks that are, that might even be confusing. Maybe it's not the best example for me. But if you want to buy more U.S. goods, you need U.S. dollars to buy those goods. So the money kind of follows the actual real good. All right, so an increase in the demand for U.S. exports leads to an increase in the demand for dollars, and therefore would tend to lead to an appreciation or depreciation of the dollar. Up, right? So we start to get this pushing up, just demand going up. Then we start to see the dollar becoming stronger, which kind of makes sense, right? If the U.S. wants a bunch of our stuff, then the dollar becomes stronger, and we start to see some appreciation. So that leads to an increase in the exchange rate, which is appreciation. Number two, the U.S. interest rate differential. A change in the U.S. interest rate differential. This is a new animal that we have not tackled before. Hopefully it'll make sense. A change in the U.S. interest rate differential. All right, so the interest rate differential is the difference between U.S. denominated financial assets minus foreign denominated financial assets. So to make that a little more clear, let's take two countries that are issuing government bonds. Germany is pretty rock solid, as well as the United States government, in paying back their debt, right? So we can look at, if you're an investor out shopping the globe for assets, you might look at the German bond and you might look at the US bond, right? And so that's what we're doing, is kind of continuously looking for instruments, maybe holding risk constant. We've kind of decided that we want a certain risk category of, you can't always chase the higher interest rate, because you got to remember the risk and reward trade-off. If something's paying a real high rate of return, is the risk typically high or low? High, right? So the risk-reward trade-off is that people who are in desperate needs of money, they tend to have to pay a higher interest rate because they might just default. The risk is higher for the lender. And so don't forget about that. So we're going to kind of hold that constant and think about assets that have similar risk and look at the interest rate differential. All right. If there is an increase in the interest rate differential, what happens to the demand for dollars in the foreign exchange market? If there's an increase in the interest rate differential, what's going to happen to the demand for dollars in the foreign exchange market? Who's going to be brave here? Jake? It goes down. That is absolutely wrong, but totally worth an extra credit point for being wrong and being willing to step to the plate and go for it. I love it. So extra credit point. Okay, so why is that not correct? If the interest rate, and this is a tough question. I mean, I don't mind, because there's a lot of things here that I might take for granted on how we're approaching the problem versus the answer that you gave. So this one's a little, I think it'll be easy once you get kind of these few nuts and bolts. But if you're out shopping the globe for an investment and this happens, why would you increase? Why would there be an increase in the demand for dollars? What's the story? I don't want to use the word safer because the risk is the same. So you're kind of wrong. I held that constant, but Bo, you're going to get an extra credit point too. I'm feeling generous today here. Thank you.
Does it matter whether that differential is negative or positive?
No, it doesn't, because I just want the change to happen. So if it's currently negative, and this one's 6% and this one's 8%, but the differential gets smaller, this climbs from 6 to 7, or let's say 8 to 8. If it climbs to 8 and now the differential is only 0, that's what I'm trying to look at. Is one relative to the other. Why would there be an increase in the demand for dollars when the interest rate differential goes up? Kind of a simple little story to it, but it's not easy. It's simple once you hear it, but I want you to think about it. Zach?
Is it because other countries will realize that the dollar is more valuable, so
okay, now
their demand will increase?
Yes, but it's not the dollar that's more valuable. So you're getting temptingly close here. Let me give you an extra credit point here for, even though it's another kind of wrong answer, but it's heading the right direction. So it's not the dollar that's more attractive, but what's more attractive? The rate of return on the underlying asset, whatever that is, which is our bond maybe in this case, if we're talking US government bonds versus German bonds. If all of a sudden US bonds look more attractive, whether, as Jeff pointed out, because it was negative, or originally this was 8 and this was 6, but it climbed to 8, all we're thinking about is the changes. As long as this one starts to look relatively more attractive than the other one, I'm going to start buying this. But there's a catch. If you're a foreigner, in order to buy this, what do you need? You need dollars, right? So you can go to Wall Street and buy this, but in order to buy it, you need some good old greenbacks, American greenbacks, which means you got to go to the market, and if you're a Japanese person and you've got yen, you need to start buying dollars. So an increase in the demand for buying the financial assets is going to lead to an increase in the demand for the currency. Again, you see how the dollars are following the underlying asset. People want to buy US denominated financial assets. In order to do that, they need US dollars. And so they're going to increase their demand for US dollars. Okay? Very similar story to what we told up here with chopsticks, except now we're thinking about financial instruments with interest rates. Okay, let me write that down if I find my black pen here. All right, so an increase in the interest rate differential, and I'll write a little bit more about what that is too. I'm losing my head here and keep jumping from one to the other. Okay, will lead to an increase in the demand for dollars, which will lead to an appreciation of the currency, holding all of the things constant. Appreciation. And so the key point to this is that US dollar denominated, all that means is that the value is expressed in dollars. It's being the particular asset is being traded in dollars. US dollar denominated financial assets look more attractive than foreign assets. I'll skip the rest of that. Foreign financial assets. You know, I skipped writing this out. Did you guys catch that with the star? What did the star mean from chapter 15? I meant to kind of point it out again as a refresher. The foreign country, right? So this is domestic country, foreign country. And so if we happen to be giving this lecture in Germany or something, then the US would be the foreign company and the Germany would be this one. So remember that this little asterisk is just kind of our notation for the foreign country. So US dollar denominated financial assets look more attractive relative to foreign assets. And so we need dollars. We need dollars. Let me write that out instead of put the, this is kind of my notation for dollars versus money, but need dollars to buy the US bonds or the US financial securities, financial assets. Okay, any questions on that one? All right. One more. Number 3 on the demand shifter list is a change in exchange rate expectations. A change in the expected exchange rate. Now we got e raised to the e power here. E, because that's what we've been using for expected inflation, expected interest rate. Now we've got the expected exchange rate. If there's an increase in the expected exchange rate, the future exchange rate, what's going to happen to the demand for dollars today? It's going to shift to the right, it's going to go up, right? So this is similar to what we did before. You know, currently estimates have it that the exchange rate's going to climb to 110 tomorrow. But all of a sudden some people start catching wind that, hey, maybe it's going to go up to 120. Buy low, sell high, right? So it's no different than you expect the value of a classic car to climb from $10,000 to $15,000, or maybe a rare painting or something. I'm going to buy low, sell high if I expect that to happen. So expected appreciation of the dollar leads to maybe a feeding frenzy today, a bunch of people buying it, right? So an increase in the expected exchange rate leads to an increase in the demand for dollars. And this one's kind of interesting. What happens to the dollar then? Does it appreciate or depreciate? It appreciates, right? It goes up. So it's kind of a self-fulfilling prophecy is what we call this. I think it's going to happen. I act on my thinking, and then it doesn't. That's kind of cool. But not if everybody's doing it at the same time. But that's what's going on here to some degree, is that if there's a change in expectations, then that will lead to an increase in the current exchange rate value. So let me put a couple notes here. This increase in expected exchange rate is an increase in the future expected value. And this is our, I should write this in a different, this is our action today because of that. And this is the movement that happens today. So it's kind of a self-fulfilling prophecy. Forgetting something. I had an H2 too soon. Prophecy, quote unquote. So that's something that's a little unique here to the exchange market.
Yeah, but if it's saying that it's expected to rise, if we start buying it now, then nothing had happened so far yet, right?
So nothing's happening now except for that, and that's what I was trying to do here with, let's suppose that we always have expectations about the future, right?
Yeah.
And so today it's currently trading at 100 yen per dollar. And the market in general, everybody's kind of expecting that it's going to rise to 110 over the next 2 years. But then our thinking gets revised from 110 to 120. And that causes a feeding frenzy today that starts to push up today's exchange rate.
It wouldn't like move down the demand line, but it's more of it.
No, because it hadn't even shifted to here yet. It's moving up. So using this, this might be kind of helpful for a variety of reasons. Remember when we drew this demand curve, ceteris paribus happened? All of the things were held constant. And so along this one, we already have an expected exchange rate of 110 in the future. Okay? Along this curve, we expect things to be 110 in the future. Now, once we ratchet that up, I used to want to buy this many dollars when expectations were 110. Now I want to buy this many. At this exchange rate, I used to want to buy this many. If the current exchange rate would have been 120, I would have wanted to buy this many because I expect it to be 110 in the future. but now I want to buy this many. And so it shifts the whole curve over so that the EE2 is relocated to the right at the higher expected level.
So what happened in Zimbabwe?
Zimbabwe, this was going up all the time. So we had an ever increasing expectation about the government. Are they really going to do it again? Yep, they're going to do it again. And so we keep ratcheting up our expectation, and that keeps going up and up and up and up. And that's how it can quickly change the values. Okay. And of course, the dollar was appreciating greatly against the yen, or the Zimbabwe dollar would have been depreciating, just like what we illustrated here. All right. So next, I want to look at the supply shifters. And I kind of wish I had a little more room, but supply shifters. Okay, so this one can be a little bit weird. So this first one is a change in the U.S. demand for imports. If there's an increase in this demand for U.S. imports, so people in the United States are wanting to buy more plastic toys from China, right? U.S. demand for imports from other countries. There's an increase in the demand for plastic toys. How does that affect the supply of dollars? This one's a little bit weird. What's that, Tech? Increases the supply of dollars. What do you think? Yeah? No? So U.S. imports go up. What do we need? Dollars or yen? We need yen, right? So an increase would cause a increase in the supply of dollars. What about a decrease? Let's think about it in reverse here. If the U.S. has a decrease in the demand for imports, what's going to happen to the supply curve? Now, since I just flipped the arrow here, Tag's logic would be that it would shift to the left. Does that sit all right with you? See how it's kind of weird? It doesn't quite, it's not quite fitting together, is it? So there's kind of some action behind the scenes. Imagine that you're a bigwig and you've got an inventory of dollars and you've got an inventory of yuan, right? And so you're kind of in the market and you've got a lot of dollars. Are you going to be bringing as many dollars to the market if you don't want to buy as much stuff? No. Does that start to make sense all of a sudden that the supply of dollars is going to go to the left? So people are going to bring less dollars to the market because of the decrease in demand for imports. So decrease in the demand for U.S. imports leads to a decrease in the supply of dollars and ultimately an increase in the exchange rate appreciation. And I'll write a few comments down on this one. Let me put it over here. So the idea with that is that we're not going to bring as many dollars to the market because we're not buying as much foreign stuff. So, key point. We don't bring dollars to the market. Because we don't need yen. All right, so indeed, Tag was right. It does work both directions, right? And that's where it's a little bit different thinking about the supply curve coming to the market. All right, so number 2. Let's see, I suppose I could give Tag a extra credit point for a correct answer too. Not just give all the wrong answers. I don't want to have, I just want participation on both sides. I don't want to discourage you that have correct answers. Okay, so any answers are good answers for discussion purposes, not for tests, by the way. Wrong answers end up bringing your grade down. So try to get the right answers once. So it's not always, is all my point is. But for discussion, it's awesome. So, all right. So number 2 here is this interest rate differential. So a change, if there's an increase in the interest rate differential, what happens to the supply of dollars in the foreign exchange market? So I won't rewrite this again, but US dollar denominated financial assets look relatively more attractive than foreign ones. So what happens to the supply of dollars? It's going to go down. In other words, if you have dollars, you don't need to bring them to the market to trade into the other currency. You're just going to hold on to them, right? So by not bringing them to the market to do the trade, you're effectively lowering that supply at each interest rate, or at each exchange rate, rather. So an increase in the interest rate differential leads to a decrease in the supply of dollars, which is going to be an appreciation of the dollar. And that's maybe worth another similar note up here. You need to keep dollars and not convert them to another currency. Okay, so last one, number 3, is an increase in the expected exchange rate. If you think there's going to be appreciation down the road, the future exchange rate is going to be higher, so you've ratcheted up your expectations. What's going to happen to the supply of dollars today? Go up or down? So we're ratcheted up the expected exchange rate. Increase or decrease? Decrease. Same logic again. I'm going to hold on to my dollars. Dollars are going to become more valuable in the future. I used to think they were going to be 110, but now, geez, they're going to be 120. Do I want to unload those in the currency market? No, hang on to them, buy and hold, but you already have them because this is the supply curve, right? So hold on to those dollars, don't bring them to the market, and so an increase in the expected exchange rate leads to a decrease in the supply curve, a shift to the left, leading to appreciation of the dollar, an increase in the exchange rate. All right, so if you look down your list of demand shifters and supply shifters, what do you notice?
Demand's up, it goes up, supply's down.
Okay, so the same thing is on both lists, which is actually kind of weird. Some of you haven't had micro yet, but normally the lists are two distinct columns of things. Here, it's the same thing. So if we think about the currency markets, we've got some people who are holding both sets of currency, and they're going to behave in similar ways depending on what they're doing with each one. So an increase in the interest rate made dollars, US dollars, more attractive, meaning you didn't want to bring your dollars, you want to hold your dollars. The flip side is if you don't have dollars, you want them, right? For the same reasons. So it all kind of depends on what you have and where you don't. On demand and supply, we've got the same interest rate differential is the shifter on both lists. Same thing with the buy low, sell high strategy here of a change in our expectations. This is showing up on the demand list and the supply list. If you don't have dollars, you want them, you're going to demand more. If you do have dollars, you're not going to sell them, right? And so in both cases, we have upward movement in the exchange rate through the forces of demand and supply are both moving the direction. So we can start to hang our hat on that if there's an exchange rate, expected exchange rate, it's going to lead to appreciation, kind of for sure, of the currency today. Jeff?
So, ceteris paribus, Q1 wouldn't move very much at all.
Right, and so what I'm kind of ignoring is the magnitude of the shifts. So if demand moved further to the right than supply decreased by, we definitely have appreciation, but there may be more, the volume of dollars being exchanged might be a little bit to the right or right to the little bit to the left, right?
Like that hashtag thing where there's a bunch of lines.
Yeah, kind of like our hashtag thing that we did in other classes. We don't know for sure where it's going to be, but we know that this is going to be the movement. And so we can kind of confidently say that we believe that this variable is going to lead to appreciation for sure, and same thing with the interest rate differential. Okay? All right. Any other comments? So let me put that note about the shifters moving together. That's a little bit odd for the currency market. So note, shifters 2 and 3 of both lists move both demand and supply, which is a little bit strange. And so we've got players in the market that are going to want to do different things depending on the shifters. Okay. Let's do this thing next. So as you've seen in other work we've done, knowing those shifters is important to maybe answering some of those multiple choice type problems of suppose there's an increase in the exchange rate, what happens? There might not be a graph here. Does it lead to appreciation or depreciation? Hopefully we can regurgitate home base. And if we at least memorize our shifters, better yet we even know what we're talking about, but if we just at least memorize the shifters, we might be able to get that that movement that it causes appreciation. Okay? So, I want to bring up a concept called the real exchange rate. The real exchange rate. So we'll kind of use RER. To talk about this, I want to recall our material from chapter 3, or chapter 15 rather, on the terms of trade or the world price. So recall our world price, our terms of trade. From our example we did, we had the world price of food equal to 3 cars for every food. So it was just our little example, and I just pulled that mostly out of my rear end. I just said, suppose that it's 3 cars for every food. You know, we didn't talk about the negotiations that went on of why it was 3 for 1. We talked about Tom and Jen on the island. So we just said, suppose that we have currently a world market in which 3 cars are being traded for 1 food. Okay? Well, that's an example of the real exchange rate. So when we use the word real, we usually have inflation adjusted, and so that we're talking about quantities of things rather than nominal prices of things. All right, so that's kind of what we did here. And there's a connection to this foreign currency because here, there's nothing real about this in terms of tying it back to quantities, tying it back to your shopping cart. It just says that the nominal exchange rate is 120 yen for every dollar. That's just the rate of trade between the 2 currencies. It doesn't really tell us what maybe the purchasing power is of that dollar amount within the country. All right, so that's what we're going to look at now. So suppose, let's do a little example. If the exchange rate is 100 yen per dollar, and the price of food is equal to $90,000. So the price of food is $90,000 for every unit of food. And the price of cars over in Japan, so we're going to put P star here. If the price of cars over in Japan is 3 million yen per car, what is the real exchange rate? And what I didn't give you is the formula for the real exchange rate. The real exchange rate is equal to the nominal exchange rate times the price of food over the price of cars in the foreign country. This is the real exchange rate, is the nominal times the price. Now, before you jump into the numbers, which I'll let you do in a second, I know you're excited, I can see it in your faces. Look at what this is. This is very close to something we did with Starbucks and Mountain Dew or Red Bull, I can't remember what it was. Remember we did the relative price, where we took one price was $2.75 and the other price was $1.39 or whatever, and we divided the prices? That's kind of what we're doing here, except we've got the nominal exchange rate involved. Okay, so go plug and chug the numbers. This is all just a little bit of arithmetic here. There's your formula for the real exchange rate. And as soon as somebody gets an answer, you can shout it out, and we'll compare notes and see what you got. Get an answer, bark it out. I see a 3. 3. Now I'd like a little more details to it though. 3 what? Is that $3, 3 yen, 3 food, 3 cars? What is it? 3 food? 3 cars?
3 food per car.
3 food per car. 3 food per car. All right. Does everybody get that? 3 food per car? Not sure if that's right. Did everybody get that? 3 food for every car. Well, let's do it together here. See, I like to kind of do it all kind of longhand here. So we've got the exchange rate at 100 yen per dollar, 100 yen per dollar, times the price of food, which was $90,000 per food. How many of you did it this way with putting this goofy notation at the end? Did you guys track through on that? Yeah, I see a couple of you. All right, so then we've got that divided by the price of cars in Japan, which was 3 million yen per car. Now, sounds like a lot of you did the math pretty well here. We got 100 times 90,000 gives you 9 million. 9 million divided by 3 million equals 3. I like that. Is everybody with the food per cars? Did everybody get that? 3 food per car? Cars per food. Somebody's changing their mind here. All right, so the reason I use this notation is that we can solve with fractions. I know this is a little scary maybe for some of you, but if we're multiplying a fraction, dollar down here, dollar up here, we've actually converted the $90,000 price tag into yen. 1 unit of food cost me 9 million yen. See that? Yen per food is what's left over. So 1 unit of food in Japan cost me 9 million yen. Now we've got 9 million yen per food divided by 3 million yen per car. And so we can do that again here. So let me just say this was yen per food, right? And now we've got, in fact, let me just do 2 steps just to make sure we're all crystal clear on this. We got 9 million yen per food over 3 million yen per car. And now what do we do when we have a fraction in the denominator? Flip it, multiply it times the numerator. All right, so we get cars per yen. The yens cancel. And we're left with 3 cars for every food. The real exchange rate. The nominal exchange rate was 100 yen per dollar. But what's really going on in terms of trade between Japan and the United States, 3 cars are being traded for 1 food. That's the real exchange rate in terms of quantities of goods. Okay? Kosher? Cool? Come on, you gotta admit it's kind of cool, right? And we can kind of convert dollars back to quantities of stuff. Getting back to chapter 15 of what really makes us happy is cars, the number of cars I have and the number of units of food. It doesn't really matter how many dollars I got. It's only what those dollars buy. That's what economics is all about, right? It's kind of parting away the veil of money. The veil of money is the thing that gets us all confused. And part of what economics does is it parts the veil so we can look behind the curtain and say, what's really going on over here? What's really going on behind the veil? And so that is what's going on here. All right, so that concept gets generalized across countries. And so I like to go through that example at first so that we can hopefully better bridge the gap between all goods and services, not just cars or food, but real GDP in each country. So when we take a more sophisticated look at exchange rates, what we'll be looking at is the real GDP in each country, which is much more exponentially confusing, right, compared to just this little simple two-good model. But yet, the logic follows that train of thought. So, note, in general, for all goods and services, i.e. real GDP, which we use the Y interchangeably, in general, for all goods and services, we use the price level in each country. So rather than looking at the price of cars or the price of food like we did here, we're going to use the price level as our benchmark, the average level of prices in each country. So we use the price level in each country to determine the real exchange rate. And so the real exchange rate is equal to the nominal exchange rate times the ratio of the price levels. And no, I wrote it a little bit differently here. I pulled the E outside of it. No big deal. With math, we could just put the E right next to it like I did in the example. Right? So I just did this. But check this out. This is very similar. We're just using the price level rather than the price of food, and the price level in Japan rather than the price of cars. But that formula looks about the same. And so that's what we do at the macro level to determine the real exchange rate. Now, another thing we'll take a look at here in a little bit is to do one tiny little algebra maneuver and bring this sucker over to the other side. So we can equivalently think that the nominal exchange rate is equal to the real exchange rate times, now we got the foreign country's price level up top and the domestic country on the bottom. All I did was bring that thing over to the other side. I don't think I actually noted this, so somewhere in your notes you could even back up a little bit. Just remember that little e here is the nominal exchange rate. The nominal exchange rate. Okay. So we talked a bit about exchange rate expectations and how those might change. And we talked about the real goods that are being traded and how they would impact the rate of exchange. And I want to introduce one of the most powerful economic concepts that is out there for international currency exchange, and that is called purchasing power parity. Purchasing power parity. Purchasing power parity. PPP. Purchasing power parity. So the main concept of purchasing power parity is that identical goods in different countries will cost the same. Like a Toyota Prius in Japan versus a Toyota Prius in the United States. So goods that are truly identical should cost the same in each country. So if I take the price of a Prius in the United States and convert it to yen, I should find that the price of the Japanese car is the same as the exchange rate adjusted price in the United States. In other words, this equation should hold that these two things are equal to each other. Why? Why would I make that prediction that the American price adjusted for yen should be equal to the price that exists over in Japan? Why? Why would those two things, why would I expect them to be equal? What's that? They're made out of the same things. Yeah, so identical cars, but that's not the full reason. One way to think about this is suppose they were different. Suppose that if I take the price in the United States and I take the current exchange rate, I do the math, and it turns out that this is half the price of this one. So a Prius over in Japan is selling for, what did we have it at? 3 million yen for one Prius. I do this calculation, and it turns out, well, geez, the American Prius, even though it's identical, is selling for only 1 million yen after I've adjusted it. Why would I not expect that to be true? Or Zach, go ahead. Whatever.
Go back to like the imports and exports, because if something's cheaper in different countries than what you get.
Good. So that's part of it. You're right. So then people would start buying our Priuses because they're cheap, which would increase the demand for Priuses, and Priuses in the United States would start to go up in price, right? Now, better yet, if I am a Japanese car seller and I can sell it in my market for 3 million yen, I can pick it up in the United States for effectively 1 million yen. What might I do if I'm a profit-minded business that deals in cars? Buy and resell. So kind of what you were saying with imports and exports, I'm going to buy the car in the United States, ship it over to Japan, and eat them up, make lots of money. Because I can sell them for 3 million or a little hair under 3 million, however you want to cut it. There's a profit opportunity, right? That's called arbitrage, is the fancy word that economists put on that. Arbitrage. Buying in one market and reselling it in another for kind of a pure arbitrage is that maybe it's even a costless transaction between the two. So obviously there'd be some cost associated with shipping the Prius. The story still is similar, but the price of the Prius would only be adjusted short of the transportation cost of bringing it back to Japan, right? So there's these powerful forces that are at play to make this equation hold. Purchasing power parity. We'd expect you to have the same purchasing power in either country. So let me write a little bit of that out, and then a couple more things I want to add, but I don't want to lose sight of this, what I wrote here. So here is the Prius in the United States converted or valued in, converted to the value in yen. Purchasing power parity says that these two things should be equal. This is the price of the Prius in Japan, denominated in yen. Purchasing power parity says that these two things should be equal. And the easiest way to think about that is to say, suppose they're not. So note, if the adjusted American price was less than the value of the Prius in Japan, if it didn't hold, then there's an arbitrage opportunity. Then there is an arbitrage. That's such a fun word, arbitrage opportunity. And that means to buy in one market and sell in another. For our example, the way we're playing with the way we played it out is that we would, from our example, buy a US Prius and sell it in Japan. Now that sounds fun to turn a buck, but we need to think about what's going on in the market. When a bunch of people think that way, because there's thousands of profit-minded people who would love to see some arbitrage opportunities, where can I buy low and sell high? That's all we're really asking here, right? And so as we do that, if we think about the demand for Prius and the supply of the Priuses in the United States, so I'll put a dollar sign here, a bunch of people saying, hey, I'll buy one, I'll buy one, I'll buy one, starts to shift the demand curve to the right and drives up the Prius. And the flip side is that there's going to be downward pressure in Japan for that price to fall, again bringing us back to purchasing power parity. Our prediction is that we'd be left with this equation holding. Okay, so buy a US Prius and sell it in Japan. This leads to an increase in the adjusted, let me write it this way, into our adjusted price of the car, and a decrease in the price of the Japanese car, such that PPP is restored. Your textbook brings you through another example of buying, I think it's thumb drives. Little memory cards or something that's pretty cheap to ship, so the shipping cost isn't very much. So if you guys go onto eBay and you find some yen denominated memory sticks, that are all 16 gig or 1 terabyte, we'd predict that the value of the memory stick quoted in yen after you factor in exchange rates will be equal to the other one on eBay from an American seller that has it denominated in dollars. The economist predicts you're not going to find deals by shopping other countries in the value of their currency because of purchasing power parity. Exchange rates are going to adjust so that that arbitrage opportunity goes away. So, summary. In general, nominal exchange rates, little e, will adjust so that the effective price of a good will be the same, whether denominated in yen or dollars. Okay, we saw part of this when we did the chapter 6 on the real GDP in each country, comparing real GDP. So in the United States, we had $46,000 per person, and in Japan, it was a little less than that, usually in the 30s. Then we had the poor countries down at $8,000 per person. We had even poorer countries in Africa that might be down to $2,000 per person. Those numbers were purchasing power parity numbers, so that globally we're thinking about the basket of goods that you can buy in each one. Because otherwise you kind of got the story, well, everything's cheap in India, which is true. Once you get there, some things are different and cheaper relative to our American counterparts, but that's been equalized through purchasing power parity adjustments in terms of purchasing power when we make those comparisons. So that's one place that we've seen this when we looked at the numbers before.
If our dollar were to appreciate, like at that moment, could we start selling these to Japan?
Yeah, it definitely affects. Won't necessarily be arbitrage opportunity if purchasing power parity is holding it. Purchasing power parity says that that exchange rate already reflects that. So, okay, similar concept, and then I got something to show you related to this that'll be kind of fun. But I want to get this one out, is interest rate parity. Kind of PPP applied to financial assets. So interest rate parity is basically same concept of purchasing power parity applied to financial assets, things with interest rates. So financial assets are where interest rates are the price. And so the one little thing to add on here for interest rate parity is that, again, exchange rates, the nominal exchange rates will adjust so that financial assets of the same risk, because remember the interest rate is tied to the risk, the nominal exchange rate will adjust so that financial assets of the same risk yield the same expected return. Considering interest rate risk too. Or I'm sorry, exchange rate risk too. And that's the last little important part to add on. Nominal exchange rates will adjust so that financial assets of the same risk yield the same expected return considering exchange rate risk too. The expected exchange rate thing. So you kind of get hit with a double whammy if you're investing in assets from a foreigner. So if you're buying that yen-denominated government bond, right, or you're buying a Japanese bond denominated in yen, you're an American. You think, hey, that's a great rate of return. I think I'll buy some of those yen bonds. Well, one part of your investment is the fact that you're buying the yen bond, which has its own risk associated with it in case Toyota doesn't pay you back, right? So that underlying bond has its own elements of risk. And then you take on this additional risk that after the bond is done and you get paid back 2 years later with 1,000,000 yen, now I got to convert that yen back to dollars. And so there's kind of this double whammy of you're playing the exchange rate market as well as playing the market for the underlying financial asset. Okay, so let's talk McDonald's. Didn't think I was going to throw that at you, did you? So let's talk McDonald's. There is a thing that some economists devised called the Big Mac Index. Have you guys ever heard of that? The Big Mac Index. And if you just Google Big Mac, should be one of the first things that comes up, index, there we go. You can go to the site that's done by The Economist magazine was the first one to publish this way back when. So The Economist is kind of a general read magazine that has some good articles. You don't have to be an economist. It's not a professional journal. It's just got some interesting stories on it. And one of the things that they created, I think it was 30 years ago, although I think we'll learn roughly here in a second. Here we go, Big Mac Index. So it was invented by The Economist in 1986 as a light-hearted guide to whether currencies are at their correct level. It is based on the theory of purchasing power parity, the notion that in the long run, exchange rates should move towards the rate that would equalize the price of an identical basket of goods. In this case, a burger. So, for example, what was the price of the McDonald's hamburger in January 2015 was $4.79. In China, it was only $2.77 at the market exchange rates. So the raw Big Mac Index says that the yuan was undervalued 42% of the time. So there's an arbitrage opportunity. I could buy a Big Mac at the local McDonald's in China, pay $2.79, grab the Big Mac, jump on a plane, run to the United States, and sell it for $4.79 here in America. And I could make a couple bucks on it, right? That's the concept of purchasing power parity. Almost sounds absurd, of course, with McDonald's hamburgers actually doing that deal. But McDonald's has the choice of how much they sell in each market. And so here's the index. That's the concept. Here is, around the world, they've continued to publish this. And they're using it to say which currencies they think are undervalued or overvalued. In other words, if you were a currency market player, you could use the Big Mac to say, you know what, I think the yuan is undervalued. I'm going to jump into the currency market and buy low, sell high, right? So I'm going to make my decision on whether I should trade in yuans for dollars by looking at the Big Mac Index, perhaps, as one area to look at. All right, so the United States is the benchmark here. So you see along this curve here, it's flat. And then these are other countries. And this thing's got kind of a dynamic element to it here. If we look at, let's see, where were we? Mexico, down in Mexico. You saw that this changed here. The peso is running 49, and so the price of a Big Mac down in Mexico, our neighbor, is $3.35. So the raw index says it's undervalued by 30%. Might be a good deal to pick up some of those. And here it is over time. Look at how the numbers, they got this thing changing over here. Over time, the exchange rates change. This is from 2000. And all the values change as you run along this. And you can go from country to country to look at how the Mexican Big Mac differed. All right, so can we make you hungry for lunch? Bringing up the Big Mac index. All right, we'll call it a day there. And so Wednesday, we will just have the test only, by the way. So we'll see you in class. You guys online, that one will need you to come in.